Hello and welcome. I'm Kevin McCaffrey with Private Markets Insider and LaCrosse Investments 37.4. I'm also your host today, and I thank you for joining us. So last month, I said it was a scary month. Early voting, COVID, volatility. Actually, was Halloween the least scary part of October? It may have been. Well, look, November is looking even scarier. Everything from election results to Thanksgiving travel, from investment strategy to tax policy. So much is up in the air, and the whole world is watching to see how it falls into place. So nothing is scarier to investors than uncertainty, except maybe the absolute certainty of a Thanksgiving debate blowing up like a bomb in today's testy environment. You can expect that result when you drizzle alcohol over a political kindling and spark a political conversation with that drunk uncle, or insert your own flammable family member there. We all have them. You get the idea. It's risky. And yet most of us will still gather our families together, whether in person or on another Zoom call or what have you. But we don't expose ourselves to that risk without hope. November is inherently hopeful in its theme of, well, thanks and giving, which are two of my favorite things and makes this my favorite holiday coming up. But we hold out hope that it's worth the effort to stay connected with family and friends. So even if we can't agree on who takes the top job in Washington for the next 4 years, we look beyond the short term. Thanksgiving has been around for 400 years. You may have family traditions that have ruled the seating arrangements at your dinner table for 40 years. Now we're enduring what we hope to be short-term struggles for the sake of the next 40 years, or maybe the next 400 years. The point is, relationships are valuable enough to take a look past the problems that face us. And in a world of private markets investing, we connect with other insiders because over time it pays off. So here at Private Markets Insider, we foster conversation for the sake of expanding this valuable community around valued investments. So let's get into it. First, a couple of program notes as we review the agenda. I'm going to share the screen here. And the following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, please use the Q&A feature. We'll answer as many questions as we can during the webinar, and we'll follow up afterward to answer any remaining questions and to have conversations where appropriate. That's kind of the whole point of all this. I'll take down the agenda now, but these and more details on speakers and the agenda and so on are available on our website for Private Markets Insider if you care to visit. And now I'd like to introduce Josh Mayfield, a founder and managing partner of Ivy Hall Capital, and also a webinar chair. And I'm obliged to note that they're a client of LaCrosse Investments 37.4, which is also a webinar chair and a supporter here today. I'd like to thank both of them sincerely for their support and expertise here in putting together the content. As background, Josh Mayfield is a founder and managing partner at Ivy Hall Capital, a lift-out team from Oryx, where they worked on over $800 million, but $800 million in relevant deals just since 2016. So a lot of perspective, and now Ivy Hall focuses on similar debt capital solutions for the middle and lower middle market. Mr. Mayfield has 19 years of experience with Oryx. They're a $300 billion institution listed on the New York Stock Exchange, if you're not familiar. And he's worked his way through all aspects of the credit business and built credit teams across a range of industries, including CMBS, energy lending, sports and entertainment, and other financial products. His leadership positions during the financial crisis of 2008, as well as grinding through the recession of 2001, contributed to his vast investment and portfolio management experience. In addition to his work with Ivy Hall, he's currently active in a variety of civic and charitable causes and has 4 boys at home in Dallas, Texas. Now, Josh is presenting background on his firm here, and general insights, as well as co-investments that will offer context for our broader conversation with LPs in just a few minutes. And with that, Josh, I know you have a few slides to share on the screen below, and I'll take a step back and just remind the audience to write in any questions using the Q&A feature. So Josh, take it away.
Yeah, thank you. Give me a second. I'll bring up the share screen. Really pleasure to be here. Thank you for the kind introduction. I don't have anything else left to say. I was going to give a brief bio, but thank you, Kevin, for doing that. So when I was asked to participate here and given the topic, and given the date, the day after the election, I was really a little bit nervous about what all I might say. So what I did was I asked the team to help me come up with some ideas, some of the thoughts that we've been hearing from our borrowers, from potential investors, to help guide the conversation. I suspect that a lot of these words here are top of your mind, ripped from the headlines: education. Kevin mentioned I have 4 boys. I've had to be a part-time homeschooler like a lot of people. And we've been hearing eviction and unrest. Really, the big word of the day, though, has been uncertainty. Uncertainty has ruled 2020. I think we are still living with uncertainty as the big word for today. A couple of things about uncertainty and other areas. Uncertainty appears over 20 times in the most recent Beige book, so it's not just top of mind with regard to private market participants. It's top of mind with regard to everybody in the industry. The Fed is thinking about it. People are unsure what is the impact on my favorite industry, whether it's a new administration or an old administration. Think about accommodative too. Accommodative also is things that we've heard a lot about. So when I put this slide together Monday, 10-year Treasury was at 88 basis points. This morning, looks like we're at 76, right? Pretty big swing in what should be an otherwise stable market. And really, what does that signal? That just signals overnight uncertainty. So again, we think that it's going to be a low rate environment for a while. That helps influence some of the things that we're thinking about. Finally, another word is safety. People are you have to ask yourself, what do we want to be safe from? Do we want to be safe from inflation? It seems pretty easy. Do we want to be safe from long-term risk? Do we want to be safe from the energy markets? I think we're all thinking about what does that look like for us. A little bit about Ivy Hall. So we are a lift out credit team. I've had the pleasure of working with my colleagues for a number of years. A lot of experience based in Dallas. Credit is primarily all we've done historically. That's our bread and butter. We focus on deploying between 10 to 30 million in mostly credit securities. I would say our sweet spot is probably in that $12 to $15 million range. As Kevin mentioned, we do have a really strong track record. We've been active in the credit markets, committed over $800 million since 2016. Our strategy is one, since we're focused on that non-bank lower middle market, our strategy overall targets 15% IRR. And finally, really one of the things that was most important to us is that we be a purpose-driven company. And so we do operate under a purpose statement. We think that there's lots of research out there that demonstrates that purpose-driven companies outperform. That's who we want to be. And so we really live by that creed. Got to have a why statement. Why Ivy Hall? Well, as I mentioned it early, I think having a successful track record together as a team is important. Also, we are a relationship-driven company. It's a relationship with our sponsors, founders, advisors, other market participants. Why this strategy? Well, here I can be accused of talking my own book, but private credit traditionally outperforms other asset classes. There's been a lot of research on a risk-adjusted basis about private credit. Ivy Hall, our strategy is a flexible credit strategy. We think that's a competitive advantage. Really, why now is this is a great environment to deploy capital during areas of economic stress, is opportune time to deploy. We don't have a historical book that we're working through, unlike a lot of market participants. And this fills a void for investors who are looking for a differentiated strategy. Ultimately, this is our purpose statement at the bottom. We believe that middle and lower middle market businesses deserve capital solutions that are customized to their needs and are provided by investors who value integrity, excellence, relationship, and pursuit of superior returns. This drives what we do on a daily basis. This is a little bit more about our history together, both collectively and individually. The partners have experienced both building businesses and growing businesses. There's just a track record from my partner's experience in the early 90s all the way through the launch of Ivy Hall Capital. That experience covers everything from the CLO space to alternative investments to various private credit strategies. Finally, just an overview of where Ivy Hall spends most of its time. We are an industry agnostic firm. I think we definitely have areas of expertise, and so there probably will be some areas of concentration. But at the end of the day, we are mostly a cash flow based loan group. We will do some asset based lending. I would say we're primarily a non-distressed originated debt group, though we do have opportunities in special situations. And finally, there is a small bit of the portfolio that is focused on equity co-investing, limited to 10%. But really, we cover all sectors from business services to healthcare to technology, music and film royalties, media production, finance, and certain energy exposure. I thought what I would do really to wrap up here is giving you a high level approach of what Ivy Hall does, but really give you two examples of transactions that we have in the market right now to really drive home our key focus. The first one here is a furniture rent to own transaction. And the rent to own business is a pretty large business. It's a $9 billion US industry. That was through 2017. I suspect it's probably close to 10 billion now. Interesting thing about the rent to own space is during periods of economic growth, it caters to the underbanked or to the more mobile consumers, those who move quite often and don't want to lug around large pieces of furniture. However, during periods of low growth or recession, it does cater to a growing group of consumers who may have lost access to retail credit. We view this as a recession resistant business, not a recession proof business. I don't think really anything is recession proof, but we like this space. We like it during times of prosperity, and we certainly like it during times of uncertainty. This is an opportunity to help a franchisee on a large national rent-to-own system acquire new stores. And so the way we've thought about this is structure a senior secured first lien term loan. We'll have a first lien on all the assets. In addition, we'll have an equity pledge of the holdco. And we've structured this to deliver 12.5% IRR or 1.3 times MOIC. The size of 25 million is really right in our sweet spot. And we think this is an opportunity that will be a good transaction for us, really in any environment, but certainly like the prospects in the current environment. Finally, and then after this, I'll open it up to questions. But another opportunity is in the healthcare space. Everybody is familiar with the macro trends in an aging population. And so within that healthcare space is a skilled nursing sector, 137 billion in revenues, growing to 175 by 2025. Again, favorable demographics, some rising per capita income, disposable income creates more of a driver to the skilled nursing area. Plus, there's a move to move higher acuity patients out of the hospitals into skilled nursing where you get better results. Here, this is an operator that has a number of facilities under their control, and they are looking for a $25 million loan to buy out a minority partner. Here I have in big red, we like a lot of the things about this, but we certainly are aware that there's regulatory and there's headline risk involved in this space. Because of that, this opportunity, it's a large company, larger than what we would typically look at, but because of that headline risk, there's just fewer dollars of debt capital available right now. So we're rolling our sleeves up, looking at a structure here where it'd be a split lien behind a bank ABL. And we'd structure that over a 5-year term, ultimately trying to deliver a little over 13% IRR, 1.4 times our money on this transaction. Hopefully that gives you a good picture of what Ivy Hall is, what we're trying to do. We have a number of other transactions in the pipeline, but I thought these two really highlight kind of the area that we're in right now in the economy, uncertainty. How do we get differentiated opportunities? How do we think about structuring in this environment, and ultimately do a good job of deploying our investor capital? So with that, Kevin, I'm going to end the share screen and really turn it back over to you and see if there's any questions.
Yeah, thanks so much, Josh. And I think that's interesting. Your focus on, the recession-resistant businesses and growing businesses, certainly relevant here today. And for this next segment, it will be moderated by Jonathan LaCrosse, founder of LaCrosse Investments 37.4. And Jonathan has a unique perspective. He put over $4 billion to work as an LP in the past with Robert Wood Johnson Foundation, and then with CalPERS, where he launched Centinela Capital to focus on emerging managers, which has been very relevant in all the work we've been doing with these webinars. So since then, he's raised over $4.5 billion as a placement agent working on his own. And I have to say, on a personal level, I've worked with him over the years, setting up LP meetings and roadshows for different private equity and venture capital clients. And he's been a steady hand in the environment for a long time, and very thoughtful. And now I'm very pleased that he's expanding his team and the capacity for LaCrosse Investments to leverage his experience and help more clients with the help of me and some others he's added to the team. So Jonathan, please share any other relevant details on your history, or basically lead us into this conversation with the panel. Thank you.
Great. Thank you so much, Kevin. It is a joy to be here again and working with Kevin. This is our 5th webinar this year, and we keep getting better and better and getting great participants on our panels. So it's a real pleasure. So Kevin is a joy to work with and a very smart guy. I've been doing this for a long time, so very well connected. So thank you, Kevin, for putting this on. So one of the things that Kevin also mentioned, that we are raising funds. We are also still allocating to those funds and putting our personal capital there. So I think that's very important to note, that we do become LPs in a lot of the products. So while we don't put the amount of LPs that some of the participants today invest, and for their underlying investors, it is meaningful to us. So anyway, without further ado, let me just open it up and just say, when you come to a fork in the road with one direction looking easy and comfortable and the other direction hard and challenging, which one do you choose? Most of us would like to choose that comfortable path. However, this year, most of us have been forced into some adversity. 2020 has seen the rise of SPACs, lots of IPOs and growth equity deals, but it's also seen the industry and a number of industries being decimated due to COVID and increasing credit defaults. So LPs and portfolio managers have had to adapt and learn new due diligence processes and monitoring techniques, including lots of Zoom calls and learning how to network like this. So today we are going to hear from 3 distinguished limited partners, and then we're going to hear further from Josh from a GP perspective. Josh used to be an LP as well. And on how they're adapting and the paths that they're traveling in private equity and private credit today. And then, as the title of this webinar was, how we're adapting for the next 4 years. So our first panelist, who I'm based here in Boulder, Colorado, Chris Keller, has gone to school here and has been in the business for many, many years. He is a portfolio manager with Archean Capital and Moelis Asset Manager. And Chris, we're going to turn it over to you first to give a brief introduction on yourself, and then there's lots of challenges that we could highlight for what we've all experienced in 2020, but maybe you could highlight what's been the most productive and for 2020 in your investment portfolio.
Sure. Well, thanks for having me. Pleasure to be with you guys. So just as a quick overview, Moelis Asset Management is a parent company for alternative asset managers with capabilities across a number of different kind of subcategories. So direct lending, credit, structured products, private equity, venture capital. We have a little over $6.5 billion in assets under management across the platform. I focus most of my time, almost all my time, on one of those products, which is called Archean Capital. Archean Capital is a private equity fund to fund, effectively, that anchors or seeds new private equity firms. So our only focus, our very narrow focus, is helping put new private equity firms in business, and structuring those investments with a sizable LP commitment to help that company sort of accelerate their business, and then creating a structure that aligns ourselves and our LPs with the growth and success of those firms as they enter the market and raise capital from other limited partners, and hopefully generate some compelling investment performance. So that's what I do. Oh, highlights. So positives. I appreciate a positive question in 2020. So I couldn't pick between the two, so I'll just quickly hit both. One of our first investments was a group called Petrichor. They're a structured healthcare focused manager. Was able to hit a final close. They just announced it this week on $410 million. Roughly half of that was raised during COVID. So that's a very noteworthy achievement for them. And we were able to actually, I'm sure we'll talk about this later, we were able to make our first COVID investment, which we just announced this week as well. So a purely virtual kind of diligence process. I'm sure we'll touch more on that. The name of that firm is Invictus Growth Partners. So those are the big achievements or highlights for me in 2020.
Great. Thank you so much, Chris. Let's now hear from Penny Paul. She is a director with Andina Family Offices and does a lot of work within credit and analyzing different funds. So Penny, if you could give a brief introduction of yourself and Andina, as well as your biggest highlight for your investment portfolio thus far in 2020. We will come back to Penny. So Simon Littlewood is a partner with Lee Family Offices, and we are delighted to have him join us today. Simon, I know that you've been traveling the world most recently, but we'll get to that in a few minutes. And if you could give us the highlight of yourself and your firm, and then some positives that have happened to you and your investment portfolio in 2020, that'd be great.
Yeah, sure. Hi, it's Simon Littlewood. I'm originally from the UK. I have been investing initially with people like HSBC, and then since 1995, we created our own investment vehicles, initially focused on Europe and the US. And then since 2000, we've focused more on emerging markets. So I've been investing in China and Southeast Asia since 2000, moved in 2006 over to China, where I'm still based. And initially, for the first 10 years, we were investing capital into China. And then really in the last decade, it's been the other way around, where we've been working with Asian investors investing worldwide, including into the US. So we've created various funds that we're involved with. We have our own family office, which is investing its capital. And a key focus that we've had really over the last couple of decades is on what's now called impact investing. So initially it was clean technology back in the 80s when we first started, and now it's moved to more general impact investing. So a lot of our focus has been on food, education, power generation, resource use, and of course, healthcare. So really for us, from a business point of view, this year's been a very good year. We have a lot of investments in the healthcare space, which have obviously done extremely well this year. We have investments in supplements and alternative medicines. They've really been going crazy as people have been looking to change their lifestyles to a more healthier lifestyle. And generally the focus now of people on looking at the impact space has actually been a huge benefit for us. So it's financially, it's been a great year. Obviously at a personal level, it's been very tough. I haven't got to see the family for over a year now, having spent 9 months in lockdown. So let's hope things get better from here.
Well, I can't imagine. But thank you so much, Simon. Penny, are you able to join us? Is your technology working?
Is it? Can you hear me?
Yes, that's great. Thank you, Penny. If you could give a introduction of yourself, Andina, and then your highlight thus far for 2020, positive highlight.
Thank you. Yes, I am the Director of Investment Analytics in Andina Family Offices, and I actually focus both on public equities and specifically private credit. We have a bunch of different investment options that we have created in-house, one of them being private credit. We also have affiliations with firms that specifically created private equity investments and private real estate investments for us as well. Our private credit fund has been around since April 2018. And I would like to say that that is actually our highlight for this year. We have done very well throughout the year since inception. We've had positive returns throughout and have managed to maintain our distributions, not needing to suspend them, although that was some kind of, we did discuss that once COVID hit, whether we should or shouldn't, but we were actually able to maintain our monthly distributions to all of our investment partners. So that was actually a highlight for us.
Well, that's music to my ears. That's great. Thank you so much, Penny. Josh, I know that you've given the intro on yourself, but if you could give us your highlight for 2020. I know starting a firm in all of this is certainly a positive, and it comes with plenty of challenges. But maybe if you can highlight, the biggest success thus far for Ivy Hall.
Yeah, other than hiring your firm, that's got to be our top highlight. Other than that, I think we're most proud about building a pipeline. When you're raising a fund and you don't have committed capital, it is really hard to deploy or build a pipeline. But given our really good relationships, we've reviewed a little over $1.3 billion this year. A couple of outliers in some portfolios, but for the most part, really proud about the ability to tap into that personal network, relying on our two advisory board members for help. So that is, I would say that's the highlight. We don't have a portfolio that we're focused on working out of right now. We're entirely focused on business building, but really, I think the pipeline is probably the top thing I'm most proud of.
Thank you so much, Josh. So Penny, let's go back to you. Broadly speaking, everyone is wondering how investors are managing investments through COVID times. For starters, have you been able to make new investments in new relationships, or are you only using your prior pipeline and re-ups?
Well, actually, we didn't stop our due diligence process this year, and we've put a number of, we have a couple that have been approved that we're in the process of doing follow-up with. We certainly haven't said we're not going to rush into new relationships. We actually take our time in any kind of due diligence process and relationship building. So nothing is knee-jerk where we're concerned. So we just have follow-up phone calls and make sure that these new relationships are doing what we expect them to do based on the fact that we had actually selected them based on specific criteria. And once they confirm, we have meetings set up, then we'll be able to go ahead. So generally, nothing has changed. We have made new investments in interesting projects with existing relationships as well throughout the year. So as a whole, Andina Family Office continues to raise capital, and that capital needs to be placed in places, and private credit is one of our flagship funds. And so we continue to grow it. And in order to do that, we have to continue to find places to actually make investments productive.
Well, that's great. Thank you. Let's turn it over to Chris. Chris, I know that you've made some investments this year, but how are you also supporting your portfolio companies and your existing funds?
Yeah, so we're a little unique in that our focus as an LP is specifically helping new firms, in that sort of firm formation process as an anchor LP. So I think there's not a lot different now than there was before COVID, in the sense that we see our LP commitment as being more of a value. There's a value added component to it, and that we have lots of back office professionals, legal compliance professionals with lots of years of experience. We've always leaned into helping managers sort of navigate and sort of build the right back office infrastructure to then turn around and attract institutional LPs who are going to have a bit of a pass-fail grade around that, what they've set up in the back office. So nothing new about that. And then on the the other aspect of value add is helping them with LP introductions. And again, nothing new or different in COVID or before. Turning around and being able to introduce a group we backed to LPs who know us and have had some familiarity with the depth of our diligence and our work and our structures, and sort of helping them with warm introductions, I think carries a lot of significance, especially in a challenging fundraising market for new LP or new GPs. Having someone who committed $50 to $100 million into that fund and is willing to kind of make personal introductions and share aspects of what got you, what made you interested, and how you built your conviction. I think this is a very different type of introduction. And so, definitely trying to do as much of that as we can to help them sort of work around a challenging fundraising market. So that's really what we've been focusing on with our managers this year.
Great, thank you. Simon, as I alluded to before, sounds like you've been traveling quite a bit, and perhaps via diligence or supporting your portfolio companies. Maybe you can talk about, because a lot of us haven't done a whole lot of traveling, maybe what the environment's like there, and how you're handling all that. Obviously, you haven't been with your family given quarantine for quite a while, but how you're just handling it psychologically as well.
Yeah, it's I'm actually in the US at the moment, which is my first trip here since first week of January, because I headed from the US into China early January. They went into lockdown about a week after I arrived, and really got stuck there up until last week, which is the first time I've been able to travel internationally. So it's been different. As Kevin knows, I tend to travel sort of 300 plus days a year normally. And this year I've done one trip. So, but this trip has been interesting because I've done 6 countries in the last 10 days. So I've done a lot of flights. And in most cases, I've been one of a handful of people on planes. So I think that the flight out from Hong Kong into Ethiopia was 6 people. We managed to pick up 2 more passengers as we flew down to South Africa. So it was a plane of 8 people. And in the airports, I mean, I took some photos, but there wasn't another human being all the way through. So I've been on about 10 planes, in total, probably less than 100 people. So the airports are all empty. Most of the shops are closed down. The Starbucks is all boarded up. I have some wonderful pictures of Gucci's shop, which has now been turned into like a squatter camp. It's devastating. So it's directly relevant to the US because there is the the US, I think, has been isolated from COVID with the debt that's been issued by the US government. I think when you go to other countries that are not in the same position, what you find is the economies are completely collapsing. So a lot of the areas where we work, I phoned up our office in Kenya and I said, how are things there? And they said, we have no money, we have no food and no business. And that sort of sums up most of the world at the moment. So that's obviously relevant to the US as particularly in its export thing. But if you look at the Coca-Colas and the big US companies, they're not going to see a lot of growth this year from their overseas offices. So China is slightly different. That's where we focus for a lot of time. China dealt with they were obviously first with the virus. They have very strict controls in place, which meant that really by the end of April, they got rid of the virus. And there were very few cases since April there, which means we were back in business really by the beginning of May, doing meetings, going out, cinemas. The first time I've worn a face mask since March has been when I've been in the US. There's no face masks, there's no restrictions on gatherings, business is back to usual. The October holiday, there were sort of, I think, 600 million people moving around without social distancing. So it's a completely different environment for what I'm seeing here and in the rest of the world. But the economy there is weak, and that again is directly relevant to the US because China is the second largest economy on the planet. If it's stalling, that's going to impact the growth of every business. And we do a lot of cross-border stuff, and a lot of our portfolio companies are US companies. They're not going to see growth from China. So it's obviously on the health space, fantastic growth, certain consumer products, but there is going to be winners and losers going forward.
That is a fascinating global perspective. Thank you. Look forward to hearing a little bit more. And I want to remind our participants, if you have any questions that you want answered, this is a group that we would love to be as interactive as possible. It's Private Markets Insider is the name, and we're trying to have it be collaborative here. So if you have any questions, please use the chat feature here on Zoom. While we're waiting for additional questions to come in, Josh, maybe you can just touch on how your process has changed, if at all, with due diligence, with underlying portfolio companies. I know that you're probably in a fortuitous position, not having a fund with the existing portfolio companies and having to deal with workouts, but you do have a pipeline. You touched on a couple of the examples earlier on. How has your process changed? And anything that Simon had just mentioned about how challenging it is to travel. How do you foresee diligence moving forward? Maybe not for the next 4 years, but at least for the upcoming, call it 6 months to a year. Thank you.
Yeah, great question. So far it hasn't changed. If you look at the transactions that are farthest along in our pipeline, they happen to be Texas based. And, I think folks are a little bit more open. At the end of the day, we are still going to have to walk the shop floor, so to speak, kind of depending on the industry. There's really no substitute for that. We can get to know management, and when we are through Zoom calls and multiple phone calls. And so that's been positive. But I'd say from the fundamental credit underwriting standpoint, really nothing has changed yet. We'll see as this healthcare deal moves along if we need to alter that process a little bit. And then, just from the underwriting standpoint, the only thing that has slightly changed, is our covenants. When we think about what is more important from a covenant package in this current environment versus what we may have thought about a couple of years ago, really focused a lot more now on minimum liquidity. So, we still have a range of covenants. We're always going to have a leverage covenant, but now thinking about times of distress, really that liquidity is key. So, I would say we're focused a bit more there on how we underwrite deals to make sure there's plenty of liquidity to get through whatever this next 6 to 9 month window is going to be.
Thank you, Josh. Penny, yeah, as you're investing in a fair amount of private credit, and it's an important part of your portfolio, maybe you can talk about the real benefits there, and you've talked about the distributions that you've gotten, but what some of your families are viewing as far as safety, diversification, income, and any other areas outside of credit that your families are seeking right now. That'd be great.
We actually, in terms of private credit specifically, we set it up as an alternative to fixed income. We don't do a lot of fixed income in-house because of the interest rate risk at this point. And when we were initially discussing it, we decided that it was a good alternative to fixed income. And if we did it right, it was a lot more productive in terms of yields, et cetera. So that was our initial focus. It's interesting, Josh mentioned liquidity, because one of our key requirements was the majority of the fund had to be invested in relatively liquid options. So we focused on that from the get-go. We have, as I mentioned, private equity and private real estate opportunities. We also do a fair number of global public equity type investments. We have an insurance investment. We also have another limited partnership that focuses on global public equities. We're always looking for opportunities in-house to round out a portfolio. We have some fabulous researchers who also look for opportunities, and what we mean by that is something that's going to give a boost to a portfolio within a short period of time. When oil was down at $20 a barrel, we put together a opportunistic oil portfolio, for instance. So we look at a wide range of diversification within our family's portfolios, with a focus on the private side, private equity, private real estate, and private credit primarily, with exposure in, as I said, public equities in various sectors there as well. Don't know if that answers your question.
Very helpful, Penny. Thank you. We did have a question from the audience. We've actually have a couple of questions. Chris, I'm going to turn this one to you. How is this cycle different from others in terms of deal flow and sector offering opportunities?
Yeah, so the last cycle that I lived through, I was an investment consultant, and I was, we obviously had touched all aspects of client portfolios, privates, publics, everything in between. My lens now is very different. I'm much more narrowly focused on private equity only, and specifically first-time funds. So take this observation with that context, I guess. One thing that we've been, I don't know if you call it shocked or surprised by, is the level of deal flow we've seen for groups looking to raise a new private equity fund, even in this environment. So I think, I think the conventional wisdom would probably suggest that in a challenging fundraising market, groups who aspire to leave the safety of a more established firm and do something entrepreneurial like this would maybe go down in a challenging fundraising market. We've actually seen the opposite, which is a pretty robust uptick in the number of opportunities that have come our way this year. So I think that's been, I don't know, I guess a contrast to what I would have otherwise expected. So I don't know if that's different than the GFC, because again, I wasn't as narrowly focused then on fund formation, but my instinctual experience is that we saw a downdraft or a downtick in people trying to start new firms in 2009 and 2010. So I think this feels different in that regard.
And just to follow up there, Chris, are there any specific sectors that you're viewing more than others that might be a little bit more recession resistant, whether it be healthcare services or other areas that you're saying, hey, we should
Yeah.
focus on and find a manager.
So, high deal flow volume this year on people trying to start a firm. I'd say that's heavily weighted to things that had kind of a tech angle to it, or kind of a growthier orientation to it for sure. This last deal we did, it's not purely a COVID remark, but in terms of just looking back over our pipeline, we looked at what we think is around 100 things that had a growthier orientation to it in the tech space over the last, call it 2 years. So, roughly half of that is during COVID. So it's definitely a weighting towards that particular category. Been surprised by how few strategies we've seen getting formed around things that are more distressed and more turnaround oriented. It seems a little different than the last cycle, which is, people were even raising ahead of the GFC as the credit markets looked a little overheated. There was definitely a large volume of fundraising activity around things that had a more distressed orientation. We've certainly seen a few, but it certainly isn't the kind of volume that I would have predicted given, the last 7 or 8 months.
Thank you, Chris. Simon, we have a question for you. What are you hearing about foreign views and shifts on American leadership in private equity and private credit?
Well, there's the polite answer and there's the honest answer. I'll go with the
small group. So
yeah, I'll go with the honest one. I think that America hasn't been viewed positively for a long time. And I think this year, with the disastrous way it's dealt with COVID and the current presidential election, I think that the faith in America has waned considerably. It's the international investors I speak to, particularly in Asia, all want to sell their assets in the US. They're not looking to get more exposure. So there's a range of reasons, whether it's geopolitical or just a complete lack of faith in the US economy. But certainly the Asian investors are looking to sell. And we're doing a lot of work in Europe at the moment with projects down in Africa. And the European sentiment towards the US is equally negative. They look at the US and despair as to what's going on. So I do not see, even down in Africa, they're talking about the inept government in the US. So there is not a lot of confidence in the US. It's sad to say. I think there's huge opportunities in the US, and I'm personally very confident that the US will bounce back. So my personal view is it's actually a good time to be doing stuff in the US. But I think if you ask me globally, no, I think the farce of the current presidential election and the choice of candidates, which I don't think is a good representation of the US, I think it puts the US in a bad light. So I'm hopeful that once this is over, going forward, the US will bounce back, because I think the strength in the technology and the financial system will see it through. But that's not what people are seeing who are not that familiar with the US.
Well, that's certainly disappointing to hear, but it's reality. We've got another question. So Simon, we're going to stick with you first, and then Chris and Penny, you can chime in. As LPs, what are the key characteristics that you look for when committing to new projects and/or managers? And given the current travel restrictions, how have you adapted to conduct due diligence on those key characteristics? So Simon, key characteristics that you look for when committing to new projects and managers, and how have you adapted?
Yeah, for me, the key thing is people. So people are the key to the success of businesses. If you've got a good management team, they can drag a business model that's not perfect into something that succeeds. If you've got a great technology but a bad management team, it's unlikely to succeed. So the first thing that we would normally do is meet the people, see what their passion is, and see how they're trying to turn that passion into a business. That's obviously been difficult this year. So in some cases, we've had to do the reverse and look at the business and then try and meet the people later. So For us, in practice, what it means is we've reduced considerably the number of projects that we do. So we've been backing existing teams and people we know rather than looking at new transactions. And when we do see new transactions, we say to them, look, we cannot do face-to-face, we cannot do proper due diligence. So let's hold off until we can actually get on the road again. So yes, it's, I think there's a lot of investors similar to us where they've actually scaled back, particularly their cross-border or international transactions.
Chris, do you want to chime in? I know.
Yeah. So Simon used the word passion in management teams. I think that's always a core characteristic that we're looking for when you're starting a new firm. You got to, you're going to have to hustle and have a ton of passion to build that business. It's hard. So that's definitely consistent. I think the word I would use as a core characteristic that I look for a lot is humility, and that has a lot to do with, I think, investment judgment and the sort of someone who's willing to sort of acknowledge uncertainty and sort of a more humble attitude towards risk and sort of not exude an overconfidence or bravado. I think it also has a lot to do with leadership and mentoring people, and people who have a lot of humility, I think, have a better skill set for building high quality teams and attracting the right people. And we're often in the position of working with people who are doing something new for the first time. So we're not in the business of investing in people who don't have an investment track record, but we are in the business of backing people who have good investment track records, but maybe haven't built or run a firm before. And so the humility to kind of be coachable and to be looking for advice and counsel from people who've done it before, I think is kind of wound up in what we look for in new teams. So it's always hard to judge that, and it doesn't kind of fall neatly into an Excel spreadsheet. So I think it has a lot to do with the time you spend and the quality of the time you spend with people and asking the right questions. And I think the one thing that is a little bit of an upside to a more virtual COVID-like diligence process is it's allowed us to have more members of our team more involved more often with the managers, because it's just the logistics are much more natural to have a deeper team involvement on the diligence process a little earlier, as opposed to getting people on airplanes. So, I think we lose a little bit in the kind of the human touch, obviously, but I think the breadth of the touch points on the investment team and the interactions with the underlying management teams is definitely better, at least in terms of volume, than we've had in prior situations. So a little bit of maybe a silver lining to a challenging diligence environment.
Yeah, thank you. Penny, how about yourself? I know we have a LP scorecard, and we have 10 different categories in it. And but curious as to what characteristics you might look for, especially you can see a lot when you break bread with somebody. What are some things that you've adapted?
Interestingly enough, as I mentioned, we've been around since April 2018, and before we actually started the fund, which is really a fund of other private credit managers or other private credit opportunities. We put together a 20 questions minimum standard requirement for what we needed to invest in. And these standards are things that we took out as important to us, important to, in combination, give us what we needed or what we wanted to give back to our investors. So we were pretty careful about that list from the get-go, and that list actually hasn't changed in the 2.5 years that we have put it into effect. We send it out to anybody who wants to reach out to us. We get cold calls, we get referrals from existing managers, and we send it out as our base questionnaire. And it includes things like experienced manager, whether it's in the particular fund or just overall more in the industry of credit. We look at leverages, we look at first position. And we have standards to all of those that we want to adhere to. So as a screening process, it's really effective. After we do an initial screen, if all of the questions are answered based on what our criteria are, which might be very, very different than others, but based on ours, then we dig deep. Then we start to build that human relationship. We start to speak to all the people that are involved, get a feel for them. And if all of that still feels good, then we actually hire a third-party expert for due diligence, a little bit more of an objective view of the firm, pros and cons. And then, of course, we go back into that relationship, talk about any cons that came up in the due diligence process, and then we meet the people. And now it's over the phone or it's via Zoom, etc. Before it's literally fly out. So we had a pretty strict process in place from the beginning, and we actually haven't had to change it. As I mentioned prior, the one thing we have done is we've added an extra layer of follow-up questionnaire in anybody who is newer into our portfolio, to see what they've done over the last 6 to 9 months in their portfolios to make sure everything still meets our criteria. A little different approach.
Yeah, very, very insightful. Thank you so much, Penny. And then Josh, from a GP's perspective, are there any characteristics that you look for in your underlying management teams, and how might your diligence process have changed given this limited travel environment? Thank you.
Yeah, just like the allocators, we put a lot of stock in the people. And so the way that comes across for us is transparency. So if we are looking at a transaction and we're having to constantly pull forward updated financials or pull forward client lists, and if there's delays or reasons why we can't get that information, we view that as very basic baseline. So to us, that's a transparency red flag. Look, in this environment, there could be legitimate reasons why those things might not be available, but for us, it's very similar. It's people, and then that shows, that first shows through on their transparency. I mean, look, if they are not willing to be transparent before we've committed ourselves together, when there is a potential covenant violation or we're trying to work together to solve some issue, we can't get a good outcome typically if there's not good transparency together on that process. So that's key for us. That's why we have to meet people. That's why we have to walk the shop floor. In Zoom is great. Video is great, but ultimately there's a live touch and feel process that's going to be hard to avoid when you're deploying credit dollars.
Great, thank you. Simon, we have another question here from the audience, and it seems like this would be appropriate for you. How have LPs approached impact ESG investing? What role weighting it plays in their decisions, and what is their approach is on CSR?
Thanks. Well, I think even before COVID this year, impact investing was the big story in the investment world. So I've been in it since the 80s. The last 3-4 years, there's been a massive acceleration in terms of impact investing. If you look at dollars going to new funds in places like Europe, it's up to 70% of all new money going into funds is going into impact funds. And with the change in the regulations and budget in the EU, impact investing is now not only on the private equity side, but also on the debt side. So impact investing last year got this huge boost. The big problem though, and I speak at a lot of impact investing conferences worldwide, and there's a lot of money now in the sector, but the problem is deal flow. So I get people coming to me saying they want to invest in impact funds, and they say, what should we invest in? And the problem I have is that a lot of the fund managers are really struggling to find things that are good to invest in or meet the criteria. You mentioned CSR, but the problem in the impact space is it's becoming a lot more regulated as there's more money going into it. So they're setting criteria like ESG and defining exactly what impact or ESG or CSR is. And that's making it a lot harder for the fund managers. I sat on a panel last year in London. there's a lawyer on the panel, and she said, I love this because the moment a fund manager steps out of line, I'm going to sue them on behalf of the investors. So what we're seeing is, although there's a flood of money into the sector, the fund managers are getting more cautious in terms of what they invest in. And that's narrowing their ability to invest, which means the returns they're getting are not interesting. So what we're doing is we're investing directly into projects and building those projects to the point where they're big enough that the institutional and the impact funds can get involved. So we're trying to create the pipeline. And I think as an investor, whether you're an LP or if you're a GP running an impact fund, the real opportunity in the impact space is at the early stage in terms of trying to create that deal flow. And a lot of that actually is at the credit space as well. So the big issue we have is a lot of these projects tend to be longer term. So if you're doing water treatment, if you're growing plantations, planting trees, you're looking at a 2 to 5 year period before you get cash flow. And that's where you need to get the credit guys in. So a huge opportunity, I think, is putting MES and other credit services and credit insurance into the space to be able to bridge that period before the cash flow comes in.
Thank you, Simon.
I was actually going to add to that, if you don't mind.
Oh, sure, go ahead.
So, one kind of putting on more of a forward-looking view on ESG and impact investing, something that I kind of learned about, I guess, last week or a few weeks ago, seems kind of an interesting thought process. So one of our managers that we had invested in has invested in a software platform to track ESG sort of key performance indicators at their portfolio level. And this is, granular down to like different sites with different benchmarks and stuff. And this is going to be available to limited partners to review. And I find that kind of an interesting, just an interesting thing to think about how that's going to get incorporated into more and more LP maybe requirements is what gets measured gets managed. And so if more and more LPs have access to kind of ESG KPIs at a portfolio company level, I think there's a potential for this to become more of a push from the LP community. And it's cheap enough that I think it's going to be hard for GPs to not begin to incorporate this into some of the reporting, and the fact that it's user friendly for the LPs and self accessible, I thought was a pretty interesting new technology. We'll see what the impact is in the next couple of years, but it's the first I'd heard of that. So I don't know if Simon, you've seen stuff like that, or if anybody has thoughts on LP demands for greater transparency around ESG reporting from their underlying managers and the portfolio companies.
Yeah, actually, that's the key issue in the sector. I think there are various reporting software technologies. There are a lot of consulting firms obviously set up. The big accounting firms now all have ESG and impact assessment teams, and there's a whole host of smaller consulting firms. It's definitely necessary to avoid litigation. You cannot have an ESG fund and not be able to certify that everything in the portfolio is ESG. The real issue, though, is that a lot of the projects in the impact space are not in developed markets. So if you're doing new power construction, it's unlikely that you'll be doing that in New York State. It's more likely that you'll be doing that in Brazil or in Africa. And that's when the whole ESG thing gets more difficult because of the inability to get the underlying data. So what we've been looking at, and I think which a lot of these software companies and these service providers are looking at, is how do they get access to the data in emerging markets, which is where most of the projects are. And that's why I was in Africa last week, because we're working on the AI companies and the drones and the remote management service companies to look at these tree planting projects, the agriculture projects, the carbon capture projects, which are all booming there, but not able to certify that they're ESG, so therefore they can't attract the money from the ESG funds. And there's this big gap in the industry with the managers sitting on cash and the projects not able to access it because they cannot certify that they meet the criteria. And one thing that's I mean, the big money in this space is in the climate bonds and the green bonds, which, you know, even people like Apple have been raising these funds. So there's a huge wall of money there. The issue is, how does that get deployed? And anybody that can find solutions to that is looking at a good investment.
Well, that is a great preview, and maybe we'll have you guys come back. Our next webinar is the first Wednesday of December, and it's going to be focused on impact investing, and as we get near the season of giving. So we'll have some additional speakers there, but would love to have your views. But thank you for those questions in advance. I know we are nearing our 1 hour, so I'm going to ask a final question here to each of our panelists. Penny, let's start with you. The question for everybody is: here we are on November 4th. A lot of our current clients, amongst others, want to get a deal done before the end of this calendar year. A lot for tax reasons, and a lot just because it's the end of the calendar year. Are you going to be making new investments before the end of this year? And then, is looking out into 2021, what are some private equity, private credit strategies that you're most excited about? So a couple of questions there. We'll start with Penny, and then we'll go to Chris.
We absolutely have new deal flow coming in from clients, actually this month and next month, that are on the roster that will then be turned around and invested inside of private credit. Is one that is actually getting a fair bit of capital in. So we already have planned where that's going to go. In terms of 2021 and actually late 2020, one of our, within the private credit space, we've looked at a relationship that we had that's actually moving into a distressed credit space because of a lot of decisions made in the credit environment. There's a lot of opportunity there at this time, at least in the shorter term, in the distressed credit space. So that's a particular manager that we're heavily looking at this time.
Chris, do you want to jump in next?
Yeah, I think the first half of the question is another deal kind of rest of this calendar year, and then kind of looking forward into 2021, I think is what you're asking, right?
Correct.
Yeah, so for the rest of this year, I mean, I think I mentioned earlier, we do have a pretty robust pipeline. So I guess my answer to that is maybe we are reaching the point where just the gestation period of diligence and legal and everything else makes it, possibly slip into 2021. But I think, we're generally trying to solve for a specific business need for new GPs. So I guess, never say never, but we are open for business in that regard. In terms of 2021, or what just things that I find interesting, this isn't necessarily an investment focus for Archean or what we're doing with new GPs, but as an offshoot of talking to groups that want to raise their first fund, a market opportunity that I find kind of intriguing is independent sponsors, and finding or building, funding platforms to help independent sponsors get deals done. So, a natural plan B to a lot of the conversations that we have with aspiring GPs. Maybe we're not ready to anchor a fund. Maybe they're really not ready to raise a full-fledged, blind pool capital. Go off and execute some deals and come back and talk to LPs in a couple of years. That's sort of a natural transition to how do you raise money as an independent sponsor. And I've seen a few groups raising some sort of creative pools of capital to help finance those in more of a portfolio perspective, with some unique structures around those. And there's some interesting ways that those deals don't get crossed from a carry perspective. So there's just a lot of people picking around this space, and I think it's I haven't seen one that's kind of solved it perfectly yet, but I do think that this is an area where LP community is going to eventually gravitate to, because it there's a natural inclination in a lot of investment staff to get more transactional. So fund of funds become direct funds become secondaries or co-investments. And I think sort of the evolution kind of away from a classic 10-year fund with a 2 and 20 structure, there's going to be a lot of LPs looking for ways to do that, to either manage down the costs or just increase the control over their portfolio. So, again, it's not really specific to Archean, but I just think it's an interesting market opportunity that's probably worth keeping an eye on for the next few years.
And Simon, if you could touch on both of those, you're going to close any deals before the end of the calendar year, and then what do you like for 2021?
Yeah, we've actually got 2 transactions we're looking to close before year end. And it's really to put ourselves in a position where we can focus on 2 sectors in 2021 and going forward for the next few years. So one transaction is actually in the agriculture food space. We are very aware of the issues in the whole food industry, partly because of COVID lockdown, which has disrupted logistics, but also because of generally there's more people eating more. So we've focused very heavily on the agri-tech space and ways of localizing food production to get around the disruptions caused in the global logistics industry. So we're investing in a platform that actually monitors food production and then the distribution and the payment systems. So that's one transaction we're looking to close. The second is slightly more general, which is fintech. We believe there'll be significant disruption in the finance sector, which is long overdue, and that a lot of the traditional funding routes will be replaced going forward, particularly with the flood of cheap money coming out of every government worldwide, with interest rates at virtually zero. So there's a surplus of cash worldwide, and the issue is going to be how do you allocate that cash to get a return? And a lot of the opportunities are going to be in non-traditional markets. So the idea of just putting money in real estate and in New York is probably going to be over for a while. So all this surplus cash has to find a home, and what we're doing is investing into a fintech platform to bring alternative investment opportunities to investors, both institutional and private, using digital assets and using cell phone-based investing. So those I think are big themes, not just for 2021, but for the next 5 years plus going forward.
Fascinating. Yeah, I'd love to talk to you about that further. But Josh, we're going to go full circle here. Since you kicked off the webinar, we're going to have you also close the webinar here with your views. As Chris mentioned, you are currently an independent sponsor. You do have deals, and you want to get those deals done in addition to raising a first-time fund. So if you're able, are you going to be able to close a deal before the calendar year? Are you hearing that underlying companies want to do that for tax reasons? And then what are your areas of interest for 2021? Thank you.
Yeah, this is always a busy season. People are always looking to get deals done. So as a lender, you're a bit of a taker on that. So if you're chasing a deal and the client needs to get it done, then you're going to get it done. The 2 transactions we have, one definitely needs to get closed by year end. There's a real need on that buyout. The other one I think is a little bit more fluid. And so on both of those, we are, probably 3/4 of the way through diligence, and absolutely, we have these as good opportunities, and we're hopeful that we can get investor interest to get those done. Outlook for next year, really, the strong suit here for us is that we have the ability to do new non-distressed opportunities, things like business and financial services and healthcare services. I think are going to be areas in 21 that we spend a lot of time on. And then on the special sit side, really, this is where the horsepower of Ivy Hall comes in. We've been through multiple cycles together. My partner has significant workout experience. I've led portfolio management through financial crises. And while we don't, enjoy financial distress, it's hard on everybody. Certainly opportunities for us in production, finance, and the media space. The energy sector provides significant opportunities. And so we think that 21 will have a lot of those special sits opportunities for us. And so hard to pick one particular industry, but I am excited about those opportunities I think we'll be able to execute on.
Well, thank you guys. I really want to thank this distinguished panel, Penny, Chris, Simon, Josh. You guys were great. I know I stayed up late last night watching the news. My wife finally said, I don't think we're going to get the result tonight, so let's get some rest. So thank you for joining us bright and early here. Enjoy the roller coaster ride of the news for the day, maybe weeks to come before we know the outcome. But thank you. This has been great. Please join us for our next webinar. Like I said, December 2nd on impact investing. And I'll turn it back over to Kevin for closing thoughts.
Thank you very much, Jonathan, and thanks again to all of the speakers. This has been a great discussion. My big goal is to get you out of here early, which I think everyone can appreciate with all the Zoom calls and everything that we've been doing. And I'm sure some people are eager to turn the TV back on or check, I've personally turned off all my notifications and so on. So as far as I know, the world has changed since we've been on this discussion, but I think it's good to hide away and look at, prioritizing investments and long-term thinking when so much is happening on a daily basis, whether it's the markets or politics and so on and so forth. But I look out the window and it's still there. Some people wondered if that would be the case, today, the day after the big election, and New York is still standing. So, folks, I thank you again. Our next webinar, as Jonathan mentioned, is December 2nd, and you can sign up now on the website. There's not a lot of detail on there. We're sorting out some of those details as we like to be current, and a lot of these details come together as we approach the date. And I'll send out links shortly to all of you. I hope you don't get too many emails from us, but it's the nature of things. We'll be announcing more details, and we're still open to a couple of speakers because we're looking at different structures for these. And we'll kick off the holiday season discussing which investments do well and do good. And I was very happy to hear some of those questions and comments come up here today. Shows everyone's thinking about how this industry can be helpful, and I really think it can, whether it's public-private partnerships or just putting money to work in helpful places and so on. We at LaCrosse Investments 37.4, our goal is really to make a lot of money so we can give away a lot of money. And Jonathan repeats that on a regular basis. So as I mentioned, I'll follow up with some of you to contribute to this community with your input and expertise as speakers or otherwise. And I welcome ideas on how we can make these webinars more informative, more engaging, and so on. Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content and our community. And the marketplace, which we're putting together shortly, that will provide some more listings of different clients and deals that we're seeing. We'll be doing more to focus on individual deals since they're popular, and co-investments like you heard from Ivy Hall today, and featuring funds on that marketplace. But for now, we're doing it all through good old one-on-one conversations. It's very important in this business. And facilitating diligence materials and everything you need to get through your process. That entire process will be more useful to you if you help us to understand your goals and preferences. So I'll follow up to chat soon. And meanwhile, I hope you have a happy Thanksgiving. Stay safe and sane out there. Thanks again. Bye.